Hey everyone, welcome back to our channel. If you're new here, please subscribe. I'd really love that if you're returning. How you doing? Grab your coffee, maybe some tea, definitely a snack. I could go for some salted caramel chocolate. Oh my god. That's what I need right now. So, I want you to envision when it's still sunny and mild outside and it's beautiful. You want to go to the beach. You know, it's really tough to imagine that a winter storm is brewing in the distance. Kind of puts a damper on everything, huh? But it's probably coming, huh? Just like we got a hurricane headed right at us in the Tampa Bay area. But have no worries. We're on top of it, right? We're prepped and we're ready. But the economy, it's still on seemingly sturdy footing. Job growth seems solid. Consumer and business spending have held up, despite historically high inflation and sharply rising in interest rates. Or so they say. And yet, there are mounting warning signs, my man. Employment gains are slowing. Saving cushions are wearing thin. Price increases remain high. And corporate profits, which have stayed strong, appear to have softened, underscored by a bleak FedEx warning just last week that contributed to a major, massive stock market sell-off. Now, perhaps the darkest cloud over the economy, economists say, is that aggressive Federal Reserve interest rate hikes designed to tame inflation are likely to take a bigger toll on growth in the months ahead. Now, the seeds of recession have been sown. In an interview that was done, Chief U.S. Economist Kathy Bostjancic, not even going to try and pronounce it, said that the Fed is on a mission. Yeah. They're raising interest rates sharply until inflation slows down, even if it triggers a downturn. Because, like, they care, right? So, the odds of a slump are growing. Economists surveyed this month, say there's a 54% chance of recession next year. I believe it's already happening. And according to their average estimate, up from 39% in a June survey. Now, a recession, if you don't already know, is a significant decline in economic activity, including jobs, retail sales, consumer spending, and industrial production. And this is all according to the National Bureau of Economic Research, which declares the beginning and end of downturns. Still, not all experts are foreseeing this slump in the next 18 months. But, like I said, it's already happening. Now, another economist believes that the U.S. will dodge a slide unless the Fed hikes its key interest rate even more aggressively than planned if inflation does not come down quickly enough or there's a shock. They're really trying to push hyperinflation because they want that 2%. Shame. Now, such a trauma could include the re-emergence of a more virulent pandemic or an overseas crisis that drives up gas prices again. Now, barring such events, Some believe that low household debt and abundant savings should allow the nation to withstand the effects of high inflation and rising borrowing costs. In other words, economic activity should grow more slowly, cooling inflation, but not decline. Consumer spending was resilient earlier this year, but the savings that fueled it, they're dwindling. A core measure of retail sales was flat in August. Imagine that. And economists that surveyed, they expect consumption to rise just 1% next year. What fantasy land are they living in? That's my question. Now, while wages are still increasing, yearly inflation at 8.3% in August is climbing faster. As a result, Americans are drawing from the $2.6 trillion in savings that they built up from the government aid and hunkering down during this health crisis. And that figure is actually down to like 2.5 trillion right now. But the checking account deposits of low-income households have dipped below the pre-pandemic levels in the final months of 2021. And we're about 25% lower than threshold this spring. So those households are important to the economy because they tend to spend rather than save most of their income. Now, it is still expected that consumer spending will grow 2.5% this year, but fall 0.5% in the first half of 2023. And earlier in 2022, most Americans spent more on discretionary purchases than they did a year prior. But now, a slight majority are spending less, according to August figures from Visa's Spending Momentum Index. And while lower income households are drawing down their savings amid soaring prices, higher income people largely have exhausted their pent-up demand after returning to dining out, traveling, and other activities. When stock and home prices increase significantly, Americans feel wealthier. They spend more. And when those values fall, they dial back. The S&P 500 index is down about 18% this year, as the Fed has sharply raised its rates. Since it's taken 6 to 9 months for falling asset values and affected the spending, stock investors, they could start moderating their purchases this fall. Every $1 drop in wealth decreases spending by 3 cents. The impact could be larger now because households have a near record of 40% of their financial assets in stocks, which is up from about 30% from 2015. Now, companies have maintained that these fat profit margins, even though they have had to pay more for materials and hike wages to deal with worker shortages. And that's because they've enjoyed the robust revenue growth and unusually high pricing power. Yet, that's about to change as consumers temper their spending, and its estimated earnings of the S&P 500 companies grew 3.5% in the third quarter, which would be the slowest pace since 2020. Companies will reduce hiring and capital spending. Employers added a solid 315,000 jobs in August, but that's down from an average 455,000 jobs the first 7 months of this year. Less job creation means less income and less spending. Also, average weekly overtime hours for factory workers has dropped 11% since February to the lowest level since 2020. And that's worrisome because the amount of overtime logged by existing workers can foreshadow future hiring. So, it's only going to get worse. It really, truly is. Sorry to say. And now, stock investors have been waiting to hear from the Federal Reserve about the central bank plans for interest rate policy in the next year or two. Okay. And what they found out wasn't good news in their heads. Okay. After oscillating in both directions following the announcement and subsequent press conference, the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, all started heading lower with losses, ending up just short of 2% on that day. Now, the Fed's decision indicated its resolve to put fighting inflation ahead of protecting economic growth, calling the bluff of Wall Street bulls who had hoped that the central bank would turn more dovish as gas prices peaked. Perhaps the biggest indication that the stock market now fully expects a recession is the fact that the single stock among the Dow Jones Industrials that posted a rise in stock price was Walmart. Yeah. Much of the Federal Reserve chose to do what was fully expected. The central bank boosted its federal funds. We've talked about this. How many times? However, what did seem to surprise investors was the resolve with which Fed Chair Jerome Powell, remained committed to fighting inflation, even at the cost of economic growth and possible, or so he says, recession. But it's already here, like I said. He acknowledged that high rates will cause economic pain for millions of Americans. But what the hell does he care? It's not affecting his pocket, right? And he also knows that it's going to weaken the labor market and raise borrowing costs for consumers. But like I said, what the hell does he care? It's not affecting his wallet. So much is going on right now. We haven't seen anything yet. We really haven't. All right, guys, I'm out of here. I love you. I'll see you in the next one. You stay safe. You stay positive. You keep prepping. And as always, fear less. Ciao.